Hey, everybody. Welcome to Market Mavericks. It's great to be here. I'm joined by Scott Melker and Mike McGlone. We are here to break down all the action because there is a lot of action. I was just looking over the charts. We're seeing the dollar ripping higher, yields ripping higher. The market's rolled over from early action to the upside today. And I want to kick it to Mike real quick. Can you give us a summary, Mike, on what the CPI data showed and what it means?
Nothing. It means nothing. It was...
well, that's
we can share the screen. I'll just pull that up real quick.
Let me do it.
Well, okay. So if you can see my screen, I'm showing the trying to figure out the nuances of day to day of each monthly uptick or downtick is just annoying. Why bother? I don't know if you can see that. Just making sure you can. And you can see it.
Yeah, we can see it.
Mm-hmm. Yeah. Okay. So the key thing is core. Ex-food and energy CPI was 4.1%. The Fed's target is 2%. Okay, well, got that. They're not going to be easy. CPI year over year is 3.6. That's down from was 10 last year. It's clearly heading lower. But the kind of thing I say is just ignore the hype. It's just so much of it. Any 0.1% here or there they're just annoying. I mean, to me, the macro is kind of what I'm showing you next. Go ahead. I can put that screen back up.
No, I was just gonna just rebut there and say, okay, so if it means nothing, why were the markets up initially and then we've seen a reversal back? It's been a pretty big sell-off and yields in the dollar are spiking back up. So why is that happening if the CPI was no big deal, right?
Excuse. You got an excuse to trade. That's all it is. It's markets. This is one of the things I enjoyed learning my first day in the trading pits in the 80s when I walked into the Chicago Board of Trade is you basically sit there and do nothing all day. Piece of data comes out and everybody moves. It's just a trigger to move. And whether the data is bullish or bearish sometimes doesn't matter. It's just like, okay, so here's what matters. I'm kind of pointing out here, just a small chart of the Bloomberg's Industrial Metals Index. It's down 15% this year. That's hardly never happens when the stock market's up. And I overlay that with Bitcoin, which is in orange. It's down too. The thing that's the outlier here, which I show you in light gray, is the S&P 500. So the macro is, okay, we're past the data. It's meh. It's kind of PPI and CPI included show the Fed's not going to ease anytime soon. We're heading towards recession. That's kind of a known. The final shoe to drop is the stock market. It's starting to drop. Now, we've already had, I think, a pretty good peak in bond yields and crude oil. Right there, crude oil. We've had the peak, crude oil peaked around 95. US 30-year yield peaked around 5%. And they're starting to tilt towards what I think is this recession that should be kicking in. We should see the lights of the eyes be in the Q4. So here's my scenario is what should lead the way down are cryptos. Bitcoin. I published, this is part of what you see in this chart here. In orange is Bitcoin, in white is industrial metals, in gray is the S&P 500. And the leading indicator status of Bitcoin, I think, is still underappreciated. And I like to point out the last few Fed eases were on the back of Bitcoin collapsing first. So to me, there's the macros. We're heading towards that recession. I show you inflation's really high. The Fed's probably done hiking, but they're stuck. They can't ease. And the stock market's the most elevated by some measures, at least it was in decades. It's just starting to come back.
So I'm looking at your chart and I see the S&P line is that kind of lighter white one. And then you got Bitcoin. And then, so do you think that's kind of like Jaws, right? You think that's going to close with, do you think that Bitcoin and the metals will go lower, but that the stock market will just come lower faster?
So that's the key thing. That's the $1,000 question. And my answer is, I think the stock market's going to decline like it did here. This is a symbol. That's a magenta line, shows recession. Decline for a normal recession, which, yes, everybody's going to say, oh, it's not going to happen. Oh, you said this a year ago. You're too early, of course. But what's happened since then is we hiked rates another 100 basis points this year. And it's just starting to tilt that way. So I think what's going to happen is I believe what's happening with industrial metals, with copper, with the inverted yield curve, and with cryptos, not just Bitcoin. If you look at broad cryptos, they're trading horribly and they bounce, but they're starting to head back down again. And what's happening with liquidity? Liquidity is still negative. M2 money supply is still negative. So to me, this is that tilt towards the stock market's going to go down to its historical relationship, I think, with copper, which is right about the same price. And if I can find that chart, it's Right there. So this is copper and the S&P 500 on the same scale. So when I show you an orange, that's just the S&P 500. You divide by 1,000, and that's copper in dollars per pound. They trade tick for tick since basically 2015. I don't show you here 2019, but what's significant, what I think fits into your space, since you like to focus on the technicals, is the 200-day average in the S&P 500. It kissed that level last week. Remember, it was a quick quiz, and it bounced up. You know what happens when markets kiss things like that, and everybody thinks it's okay, you're good. You get the people feel comfortable about being long, and then you stop them out. And to me, that's happening. Copper is signaling it. Industrial metals are signaling it. Weakness in cryptos are signaling it. And this Fed, that's just, they're jawboning, but these inflation numbers are nowhere near where we're going to have to get for Fed to eat.
Yeah. So Scott, what are you thinking? Like CPI data comes out this morning slightly. I mean, there were a couple little slightly hotter than expected. PPI, same thing. And I think to what Mike's saying is it tells us higher for longer is in play. But will the Fed actually raise any more, or you think they're done at this point?
I think they'll raise again. I don't know when they're going to do it, but I think that they'd signal another 0.25 raise. I think that this morning was interesting because it confirmed a similar pattern that we see every time on Crypto Town Hall this morning on my show. It opened, it was up, and I said, I guarantee we end the day down. The first reaction of the markets to these news events is almost always the wrong one. I don't know if that's because of high frequency trading and bots and algorithms, but it takes a while for that news to process. I also think it's sort of a nothing burger, except for that it just reinforces the fact that the Fed is going to keep doing exactly what the Fed has said they're going to keep doing. We talk about the same things every week, but the fact is people are inherently optimistic. The predictive markets tell you all these things that the Fed's going to do, and they've never done them. We have a year and a half now almost of data of everybody predicting the Fed easing or changing their tone or not doing what they're saying, and it just never happens. The Fed's going to continue. They're going to stay higher for longer. We're not seeing cuts anytime soon. And when we do see cuts, by the way, look out below. That's when you have a problem. I literally don't understand how anyone can look at a historical chart and think, great, we're going to pivot and that's going to be good for markets, because they only pivot when things are really bad.
Right. Especially with inflation that's now elevated. If they're going to pivot at this point with inflation north of 3%, it's really got to be bad, to your point, right? So do you think that that's like, so one of my big things about the markets is that it seems like there's so many younger people investing ever since COVID, ever since the crypto boom. There's a lot of younger people that honestly, they haven't been through really a recession, right? I mean, they went through COVID, but let's be fair, we were back to all-time highs so quickly. It almost was a false flag, if you will, because it just isn't the reality of situations. I mean, do you think that that's part of the issue here, is that people just haven't experienced it?
100%. Listen, everybody knows the term "don't fight the Fed." But for the majority of investors, that only means one thing to them, which means the Fed will always be quantitatively easing. They'll always be printing more money and things will only go up. So don't fight the Fed always just meant get long. What they don't realize is that for the last year and a half, don't fight the Fed meant stop buying stuff, don't get long, even get short, because the Fed is telling you they're going to do the opposite. I think that all these younger investors and traders, they're just programmed, as you said, to believe that the Fed is going to ease, things are going to be different. The Fed is lying. The Fed really doesn't lie. Jerome Powell tells you exactly what he's going to do, and he does it. People just choose not to believe him. So, yes, I think that, Bitcoin, crypto traders, they've only existed in a phase of easy money. This is the first time that we've really seen it during tightening and hawkish policy. And also, I mean, we can get into it another time, but there's also a very major disparity between what the Fed is doing with monetary policy and what the Treasury and such are doing with fiscal policy. So you sort of have these conflicting momentum of one sort of easing by, printing a ton of bonds and then the other sort of tightening by raising rates. So it's just really a mess, I think. And right now, the easiest thing to do is just take a very, very long-term view and not do anything aggressive.
Yeah. And I'm just going to pop up my chart here, guys. And I just want to show this here on an intraday basis. So this candle right here was when the CPI data came out. So you did see a reaction in the dollar to the upside. The markets, like Scott was saying, were actually neutral to positive when the market opened at 9:30 a.m. Eastern time. But it's this continual grind higher in the U.S. dollar. And if we look at the 10-year yield, it's the same thing. And we know in general on a day-to-day basis, the markets work inversely to yields as well as the dollar. So this is the yield right here. So we saw the pop on the CPI right here, and then the continued up move throughout the course of the day. We are rolling over a little bit today. And if we flip over to the intraday spiders, look, bouncing, right? So, I mean, it is for those of you out there that are new to markets, this is more for day traders and short-term swing traders, but there really is this inverse relationship to the markets with the US dollar and yields at this point. So I think at this point, like one of the questions I would have for you guys is like, are we, number one, did yields top out? I'll throw that maybe to you, Mike. And number two is, are we going to see a recession by year end, or are we pushing this into, I mean, it sounds like all of us agree that there's a recession. The question is at what point?
Yes and yes. I'm just definitive. If you want someone to blame me. I just see it happening. I've seen these things before. Virtually, I mean, the amount of nuances, share my screen when you get a chance. I've heard about
I got it up.
Well, that's just Fed funds, but I'll speak to that in a second. But the amount of this dialogue I've heard about the budget deficit and yields going up is, I've heard that for 40 years, and every single time yields spike on that, which they do in the short term, it's always great buying opportunities. Maybe it's different this time. So here's one thing where Scott and I disagree. This is Fed fund futures in the year. It shows that we're basically down to only 10%. They're going to hike. Remember we showed these numbers. This is not, it's still showing 543. The current rate is 533. So it's taking it away. The key thing is it's not taking away enough yet. We haven't had enough. The stock market hasn't gone down enough to take it away. So if Scott's right and they hike another 25, that's almost a guarantee risk assets are going down. It's just the key thing is what's going to make the Fed to start easing is there ain't gonna. So to me, it's a matter of time. And I think crude oil peaked. That was a pretty good signal. And I want to show you one key article that I really enjoyed reading. I've read it. Same thing I've read for decades is it's different this time. This is the headline says a hot options trade is muting Wall Street's famous gear. And it's showing how everybody was shorting options and making a killing doing it. Man, I remember seeing that before. And I know people who blew up doing it. And when I was an option trader, I was very careful being short. Customers made me long because they always asked me to bid calls on treasuries. And so I would sell against that. But when you see headlines like this, it's like this is the kind of stuff you look back from history and say, yeah, that's going to blow up. It always does. This is a question of when.
Just one quick question I have, and you just kind of brought it up, and I think you might have more experience than Scott or I in this, but when it comes to the options market, one of the things I've read is that these 0-day options are just, I mean, it's literally making up more than 50% on a day of all options volumes. Is there a risk to this? I mean, to me, it sounds like gambling, pure and simple. Is this part of the bigger issue with too much liquidity in the system and people just being willing to take risk? And does it, like, I've heard that it could cause a crash if things go really wrong. Is that possible?
Well, I think that's the key thing that's to point out is all trading is gambling, depending on how you measure. Now, investing is just the longer term gambling, depends on how you look at it, unless you're measuring treasuries. Remember, I came from that environment. It was 1 bid of 2. You bid 1, you offer 2, and 2 bid, offer 3. I mean, that's day trade in the trading pits. This is just electronic now. The key thing is, yes, it's almost guaranteed at some point to blow up. I think in the short term, it's squashing volatility. It always does, just like portfolio insurance does, until something goes wrong. And all you need is just to hit a few stops in one day and then hit more stops in one day, and the stops bring out more stops. It always happens. That's why I think what's going to happen in this market, it's going to be gradually, then suddenly. And that's why I like to say is I just feel comfortable being locked up in treasuries.
What, Scott, we just were talking about how there's a lot of talk that the liquidity in the markets is drying up. The Fed is doing that on purpose. They're pulling money out. Obviously, the government is printing to the deficit and so forth. But like, what about crypto in the 4-year cycle? Are you a believer that the 4-year cycle will play out regardless of the liquidity in the market, or does it adjust?
I'm generally a believer that if it ain't broke, don't try to fix it. So I'm cautiously optimistic that it will play out, but I'm also aware that we're basically only looking at a history of 2 previous halvings where it's relevant. And each one of those times was obviously different with the liquidity size of the asset, its popularity on mainstream media and with normal people. So I can't say that I'm convinced it will repeat, but this is exactly what we've seen in this part of the cycle every single time, regardless of the macro. We've seen crypto is dead. There's no volume. There's no volatility. There's no interest. We've seen these same narratives. So this time it may be different because of the macro. It may very well be. But at this point, if you pull up a chart of the halvings and such, we're exactly where we should be, both with price, volume, and liquidity. What you just brought up was something I wanted to point at. Everybody's been talking about PPI, CPI, inflation today, but the real story seemingly was this 30-year treasury auction. Maybe Mike can give us more color on it, having seen it. But here you see ugly treasury auction sends the dollar even higher. There was a nearly 4 basis point tail on the 30-year sale. That's certainly going to add to the term premium. We saw the same, I think, with the 10-year auction yesterday, but this is really showing, I think, a major lull or crack in demand for bonds. And when we're, adding a trillion to the deficit a month or whatever those numbers have been, or over a couple months, you're still going to need some serious buyers for bonds. And if we're starting to see a real crack in demand for bond purchases, then look out below. And that's why we're seeing the dollar, I think, rage here. That's why we're seeing yields reverse and head back up. And that, I think, is a bigger story today than anything that's happening with CPI and PPI. I don't know, Mike, maybe you disagree, but I think this is kind of the story.
Agree. You're bringing back my history. I started in the bond futures trading pit in the 80s in the Chicago Board of Trade, and trading bond futures and auctions, every single little tail mattered. And this is the problem. The market's choking on that massive supply. What's that massive supply coming from? Deficit spending. What's the deficit spending doing? It's pumping the GDP in the short term. It's making the Fed tighten more. It's a lose-lose trajectory. So what I show you on the screen is something you talked about before. I enjoyed pointing out is TLT is basically the ETF for bonds, treasury bonds. And in white, if you take that Bitcoin divided by TLT, the chart looks almost the same as S&P 500, which is I show you in orange. You don't really have to see it. And so I wanted to show that. It's almost the same. It's Bitcoin divided by TLT, and you can see Bitcoin goes up in the liquidity and does well when the stock market's doing well, and then it goes down the other way. So here's what I think is going to happen is they're both going to go down. Bitcoin's going to go down versus TLT with the stock market at some point, partly because the issue is, I show you in white, is because rates are just so high now, 5.5% upper bound on Fed funds is just it's a train wreck for risk assets at some point. So that's what I think is going to happen is you basically, the last time we did this, had a recession, that's what happened. Bitcoin dropped versus TLT, stock market dropped, but TLT was so much higher than now. It's so low. I mean, it's the base is just.
I'm long TLT from 4 days ago, Gareth. I think you said that you bought TLT. I'm still up because I'm in roughly at like 84.5, somewhere near, relatively near the bottom between there and 85. But I'm sweating on that position a little bit. Right. And listen, this is a knife catch trying to catch the bottom. I think we all know that. Right. But, this was starting to look really bottomy. I gave the case, I think, previously for why I thought 10-year yields were topping. If you look at, TD sequential, it's printed at 9. Looks like it's going down. We've had a lot of signals. But, man, I feel like I'm standing in front of a speeding train right now. So I'm going to be really, really tight on this, to be quite honest with you. I'm still in profit, but it's hard to catch a bottom, and I might be out over my skis on this one. What do you think? I know you bought it today, so you don't necessarily disagree.
Yeah, well, so this is the tricky thing, and I may be out of it already. I have to look at my portfolio. I had a sell order that was out just a little bit above it, but for me, I still think, regardless, that's more of a shorter term trade. But for me on the 10-year, I love this trend line. I'm a big trend line fan. Trend lines just somehow work. And you can see going back to 2012, this low right through to here connects every time you hit this line. Look, pull back here. And again, to me, it's all probability, Scott. It's risk management. It's all that stuff. But to me, you should get a pullback here. So I think you're in the right position. I think sweating is, if the market doesn't make you sweat, it's not doing something right or something like that.
Yeah, I was feeling pretty comfortable earlier this morning, though, and things obviously changed pretty quickly. Can we take a quick look at Bitcoin? Because I think it's important. If Mike believes that it's a leading indicator, then I'm not feeling so comfy about the Bitcoin chart at the moment either. This is the weekly chart, obviously. Most people are probably familiar with the evening star pattern. Now, listen, it would be more valid if it was way up at the top. You can argue that this isn't even in an uptrend. You have this massive candle, this doji here, and then a big candle down, which hasn't closed. If that closes halfway or more, you have a very clear evening star here. Normally, you expect gaps up to these candles, but that doesn't happen in a 24/7 market. You don't get those gaps.
So what's that red line? Is that a moving average?
That's the 200 MA, which I was going to point out. We have the weekly coming right into the 200 MA, printing a clear sort of topping pattern right into that. I'm just not loving it. I'm not convinced. I'm going to wait and see what happens. But we had the same reaction, I think, at the daily 200 up here. Complete rejection for like 8 candles in a row before falling off. But now this is really an area people are going to be watching because the daily's right at the 50 MA there on blue.
Wow. Yeah, I mean, it's an amazing chart. I'll throw out mine real quick and we can talk about it as well here. And so, yeah, I mean, I had the same kind of general thing. This is the daily chart. So you did break above this down sloping trend line right here. and that gave us this little pop, but we ran right into the pivot high from August here, and it just stalled out. You consolidated, which could have been looked at as slightly bullish, and then you just broke below. And again, to me, price is probably coming back to this area here, this 25.50, 25.5 level or so. So I think it's interesting. I mean, there's going to be a real big battle here, and I'm ultimately still on the side. And Scott, I know, and Mike, you guys have heard me say that, and I think at least Mike's on the same page, is that I'm still skeptical with money being pulled out of the system. It's hard to imagine that Bitcoin won't go to 20 and maybe even retest. And again, people there's this emotional attachment to Bitcoin, which is fair. And I love long-term, but you have to still look at the facts. And the facts are, as money is being pulled out of the market, there's less money to invest in risk assets. And this is, Bitcoin, altcoins are number one. Those are the riskiest, but Bitcoin comes in second, and then stocks and commodities and so on and so forth. And so if there's less money in the system, why isn't Bitcoin going to go down? I don't know.
Yeah, can you just go back, Mike? I want to go to you in 1 second. I just want to show one more thing, because this is that 4-year chart with the halving, and your idea that we'll go to 20 fits exactly into this. If you guys have ever looked at it, you have all the halvings, right? You have the pumps, and then you have kind of the bottoms. Those are the only times RSI has ever been oversold on the weekly chart, or all of those bottoms every single time, 1, 2, 3. So we had that here, obviously. But what you get every single time between the bottom and the next halving is you get this move up, right? This was the one that went up to like 14,000. Everyone kind of remembers. And then the big move down, that was COVID right there. But hey, it was in the chart. Higher low, right? Every single time you get the bottom, you kind of come around and then come back down, higher low, and head up, even if it's a slightly higher low. So would anyone be surprised if we kind of topped here at 31, come down 20, make a higher low, and then head into the halving? So like even that, just a move to 19 or 20 is normal in this halving cycle. Even Mike's move to 15, if it went to 17, totally normal in this halving cycle. So that wouldn't surprise me, but I'll tell you, I'm buying it.
Me too. Yeah, I'm in the same camp. Mike, what are your thoughts? Give us something here.
So yeah, show my screen. I'm impressed with your focus on the day trade. Here's a lesson I learned in the pay trading pits: don't be a weenie for the teeny. And when you're, and that is okay. When you focus on things like TLT, my thought is think years. I think that thing's going to double in a couple of years. That's just in a normal recession, and be careful missing that trade if it happens that way. But you guys are more day trader focused. I've learned my lesson. I used to have hair. I just came from that environment, not good at it. That's why I want to show you in the screen. So I'm watching the 100-day moving average of Bitcoin. That's what you see in white. It's rolling over. And you compare that to the S&P 500 100-day, it's that crocodile jaw pattern. So I think what's going to happen is what typically happens in the world's most significant leading 24/7 traded indicators is going to just lead everything lower. And there's good reason for that. And that's what I show you in gray. That's just Fed funds futures. If you go out 1 year, Fed fund futures in 1 year, it shows what the market's expecting until this goes up, like it did here, 2018, and it did here during COVID. Until that goes up, there's no liquidity. In fact, Bitcoin and cryptos grew up on liquidity. I mean, they're so addicted to liquidity. Don't underestimate the world that's changed. And there's other chart I want to show you this a little shorter term on Bitcoin. This is my weekly. I don't usually go much less than the weeklies, but I show you that daily. Could show you the leading indicator statuses. The 100-week moving average in Bitcoin, it got way too cheap. We pointed this out too early last year, way too cheap, around 15,000. But the market's bounced back to that level. It's rolling over, and for a good reason. We're heading towards recession. Liquidity is negative. And as Scott mentioned, typically takes 2 years after the Fed first ease for the stock market to bottom. So I'm looking at this to be a normal correction. The stock market, S&P 500 to go around 3,000, copper to go around 3, and Bitcoin which has 3 times the volatility of copper, of gold, and the S&P 500 to go down because it's just so risky still. At some point, it's going to be that risk-off asset, but risk-off assets typically don't trade 3 times volatility of the S&P 500 unless they're inverted put options that have negative deltas.
Mike, what was your target on copper? You're thinking copper's going to head down to what?
$3. $3. I can show you that right here. So here's copper, $3.58. In white, yeah, copper in white is $3.50. I have it on the same scale as the S&P 500 divided by 1,000 to show you the significance of copper. I mean, they're the same price typically. Yeah, copper is a good leading indicator, and it's heading lower. So you got the crocodile jaw again, and you get the little kiss of the S&P 500 right here of its 200-day moving average. I love those trades. I just remember getting stopped on those trades all the time. But when you see that little kiss, oh boy, that's your signal. Yeah. There's a problem. You want to hug it, make people think, oh, it's going to break through it and get bearish and then go up. That's the best way to bottom. A kiss is usually not a good thing. You want to hug.
I just wanted to, I was just asking for that because also, here's a chart of my copper. This is a weekly, and if you can clearly see here, look at this wedge pattern, and look at what just happened over the last couple of weeks. We just broke down below the wedge. So this to me, and then interestingly enough, and again, I don't know if this is where you're getting your target from, but this low pivot here from 2022 is at $3.12. So that's right around that $3 potential target. And that should be good support. Right in that vicinity should be some support, depending on how bad the economy gets, right? I mean, the worse it gets and the worse the global economy gets, we could go lower even, right?
Yeah, so so what's the macro? Copper's well supplied. Its major demand source is China, tilting towards recession. Europe's tilting towards recession. U.S., it's a matter of time. Fed's still hiking. Dollar strong. Every single one of those scenarios are all bad for copper. And 3 is the enduring mean. The one thing, the difference about copper and crude oils, copper has a trend of making higher highs and higher lows since 2008. Crude oil is the opposite. It's made lower highs and lower lows. I like to point out that it's just pointing out facts. So what you point out there is, we got to avoid a U.S. recession. We have to have Fed ease really soon. I mean, the scenario is, I don't know what's going to stop that for going down, but the key thing is it's got to make it difficult. Like, if you guys can figure out that day trade, great. I just look at it and definitely weeklies. And the weeklies to me keep you more sane.
Just a quick shout out to Gary Cardone. Hey, what's going on, buddy? Good to see you in here. And you're asking if that means oil follows copper. And generally, I would agree. I think, Scott, would you agree in that phase, and Mike as well?
Yeah. We all know that Mike thinks that oil's going down.
Yeah, I'm in that same camp. I do think it is going to go down too. And the question is how low, but I think it could have significant downside just based on, the economic situation. We hear China. I think I heard just yesterday another big real estate player had some major default stuff going on. It's pretty messy there at this point. And the question is, I think oil's held up as well as it has because the hope is that we're going to get a soft or no landing scenario. Once that bubble gets burst here in the U.S. and you look at recession, then that oil trade really starts to crank to the downside. Quickly, Scott, what do you have on gold? And I got to ask you this question. You were talking Bitcoin could go to 20 and that would be normal, maybe even the 17-ish. Does that mean that for the next 6 months, you'd prefer to be in gold? I don't want to get you in trouble here.
I don't know. I am a gold fan, so I buy gold, and it's something that I hold. I think that especially, listen, people keep asking, we haven't even talked about it because we were off last Thursday, but there's a war. It's a regional conflict, but if that expanded, then generally gold and commodities are actually where you want to be, and the dollar and such. We can say obviously that you'd want to be in bonds. Mike will remind you, right? But that you want to be buying treasuries. But I generally like gold. I mean, I think that if a lot of the things we're describing happen, that I don't think you'll get the same kind of upside that you eventually will from Bitcoin, but I think that you might protect your capital relatively well. That said, and Mike knows this, I've bought a lot more yielding nicely 5%-ish yielding treasuries than I have gold because it's the safest thing to be in right now. And I don't see that changing anytime soon. But I don't think that Bitcoin's been trading really in lockstep with any other asset, right? We'd love to call it digital gold. It's certainly not trading like gold. We like to say that it trades inverse to the DXY. Not really doing that. People say it trades like a tech stock. Certainly not going up like the NASDAQ has. So Bitcoin's sort of in a world of its own. So I just lean towards that 4-year cycle right now and the lack of liquidity and don't really try to overthink it by comparing it to anything else. But I do like gold here generally.
Just touching on that about Bitcoin, the fact that and I've talked about this as well to my members, is that it almost seems lost. Like it doesn't go up on the fear trade. It doesn't go up on the risk on tech trade. Is it because people are just like, hey, listen, until a spot ETF gets approved, like nothing's going on? What about, like, I keep on hearing like all these big institutions are loading the boat on Bitcoin. But if that's the case, why isn't it going up? I don't get it.
They're not loading the boat on Bitcoin. Go ahead, Mike.
Consider the source. It's usually people who have a vested interest in going up, and that's one thing lesson we learn about markets like that. So I want to show you first. We'll tilt over to gold and my chart. That's a weekly 200 week moving average. It was a nice little kiss there again. Oh gosh, was it just a kiss and it's done? I think gold's just a matter of time. It meets the same price as S&P 500, maybe around 3,000, the per ounce price of gold. But in other currencies is doing great. But the key thing for gold is what pivoted the last time. What made gold bottom is this one metric I like to use, and that's the Fed fund futures in 1 year. It's still showing restraint. And that's what gold needs. It needs that pivot. It needs the stock market to go down. But I want to show you one of my favorite super cool charts that will be featured tomorrow. But I showed this before. This is why crude oil is going down. The number one reason. In white, that is the surplus of U.S. and Canada liquid fuel production minus consumption. That's around 6 million barrels a day. Add to that OPEC spare capacity, and see that trend? It's right now about 12% of that metric. I'll repeat it. It's the excess of supply in the U.S. and Canada and OPEC spare capacity as a percentage of total production. It's 12% now. That's just a train wreck for crude oils. You know where that was back when crude oil peaked in 2008? It was negative. It was a 10% deficit. Now it's a 12% surplus. But this is one of those things, bodies in motion. See that trend? And then I have crude overlay, and I just show 40. Every single time we have a recession, it goes down. Of course, we had negative 46 last time. But $40 is what you basically typically need to shut that supply off, that boosts the demand and help the global economy recover. I've been wrong this year. Partly the reason the crude oil didn't go down is because the stock market's still up and we've got those stimulus and we had the cutbacks from OPEC. But all of that, it makes it even worse. So this is one of the key metrics I want to point out for this program, is showing this excess of supply at OPEC, this excess of surplus capacity, this excess supply of the U.S. and Canada. This has been a primary source that's pressuring crude oil for the last 15, 16 years. The key question is, has that stopped? No, it's worse.
Is the disparity based on global lack of demand, based on like economic woes, or is it like EV vehicles, or is it like all of the above kind of thing?
All the above. So first of all, if you look at the U.S., crude oil demand peaked around 2005. That was around when I was at S&P and they said supply was going to peak. Wrong. You just love how that works. And unleaded gas in this country is actually collapsed. Demand is actually collapsing compared to drivers' amount of miles driven. It's down 5% from pre-COVID, yet miles driven is going up. Why does that? Number one, it's efficiency, work from home. But EVs, the total amount of EVs sold on a global basis now, a percentage of passenger vehicles is around 15%, according to Bloomberg New Energy Finance. Before COVID, it's 3%. It's the trigger, it's the catalyst of this war. I remember when Saddam Hussein invaded Kuwait, they put in a high for crude oil that lasted about 15 years. This is what's happening in this paradigm shift when the U.S. has just shifted to net energy exporter, this massive shift towards EVs, and it's absolutely accelerating that process. So that's why I look at, look at me. This guy's wrong if crude oil doesn't drop to $40. I think by next year, I'll probably give up if it doesn't get there. But if this latest little bounce is just kind of aggregated things, because it kept the Fed and central banks vigilant. ECB just hiked rates a couple weeks ago. And what's it doing now for the global economy? It's a wrecking ball.
Yeah, and I will go on record. I one of my two cars is an EV. I don't know about you guys, but I love it. I love being able to charge it in my garage, and it's ready to go the next morning. It's pretty cool stuff. So, all right, guys, it's a little after 3:30. I want to keep these to about 30 minutes and just action packed. And I loved it today, guys. This was awesome today. I hope everyone enjoyed it out there. Thank you, gentlemen, for joining. And next week, Scott, you might be in office with me.
We'll be in person.
So we'll Mike, you'll be the low man out there, but we'll still do Market Mavericks if everyone's available for next Thursday at 3 p.m. So thank you guys for coming in. Thank you guys for sharing your insights, amazing insights, and have a great one, guys. Take